Hi guys, I'm going to show you how to go through the closing entries in Chapter 8. So if you will go to your Mind tab, which is I know your favorite place to go, click on the 8.1 OWP. When you get there, go to the Work Together. I'm going to go through this for you, with you, but you will be responsible to make sure you submit it on your own account. Okay. As you'll notice, the worksheet here, it has all the stuff that we've done before. Okay. So we'll take a look. Here's the completed worksheet. If you scroll down a little more, here are the adjusting entries that we did in the previous chapter. So the closing entries are prepared after your financial statement. So in Chapter 7, we did the income statement and we did the balance sheet. So after that's all finished, then we do the closing entries. The closing entries basically get all the temporary accounts ready to start the next fiscal period. So they have to be zeroed out and then start over, so you don't overestimate or underestimate any kind of net income or net loss. You will notice that closing entries is a title that's here for you. If that was not there, you would have to type that in or write that in on your journal so people would know that it was a special journal and not a normal transaction. Okay. This says the completed worksheet and chart of accounts of Fix It Now for the month ended April 30th of the current year are given. On page 8 of the journal, which is important for when we post, journalize the closing entries. So again, we're getting all the temporary accounts to zero. The temporary accounts are anything that shows up on the income statement, so your sales and your expenses, and we're also recording our net income, and we're also closing the drawing, which is considered a temporary account because that employer, that owner, will draw money out of the business as he or she feels fit. Okay, so the first thing we're going to do is we're going to close any accounts on the income statement that have a credit balance, because what you do to close it is you do a transaction on the opposite side for the exact amount. Closing means to zero it out. We are going to zero everything out into income summary. So before this point, income summary has been left blank, but now we're going to use it in this chapter. So I go to my journal and I'm going to do 30 because it's going to be April 30th. Sales has a credit up in the worksheet. So I want to debit sales for the same amount that I see in the worksheet, which is the $21.60. All transactions have to have one debit and one credit, so I'm going to close that into income summary. You'll notice there's no source document for these. So just like the adjusting entries, there's no document number. There's also no document number for a closing entry. So that's the first one. The second one is to close anything on the income statement with a debit balance. So all of your expenses have debit balances. In order to close them or to get them to zero, we have to do a credit for the same amount. So we're going to go to our journal, but we do have to close them into something. So again, we're going to use that income summary. Income summary is basically used to summarize your income. Now we're going to just leave that blank for now, and we're going to start to load in all of our expenses. Let me pin this so it's easier. We'll bring this down over here. So I'm gonna, first I'll type in my names, and then I'll go back and I'll get the amount. So advertising expense. Cash short and over. Cash short and over is the only expense that doesn't have the word expense next to it. Okay, so I'm going to credit these for the amount that I see under the income statement column. Debit. So that is $4.60 for advertising, $6 for cash turnover, $125, $189, $153, and utilities is $550. We would add all of them up and we would put the amount as a debit to income summary. So I can add them all up, or I can just grab this 1483 that I see over here. That's transaction number 2. Okay, so this first one closed out anything with a credit balance. The second one closed out anything with a debit balance. The third one is to basically close out your income summary or to record your net income or net loss. If we were to do the math, we would look at income summary, and we would say 2160 minus 1483 equals 677. That 677 is the same thing as you'll see right here, which represents your net income. Okay, so we want to record that net income. Net income increases the owner's wealth in the business. So in order to increase the owner's wealth, we have to credit the capital. So let's go to our credit first. And the guy's name is Connor Whitney. I'm just going to triple click that. And this transaction does two things. It records your net income, but it also closes the income summary. If you compare these two right now, you have a credit to income summary of 2160, a debit to income summary of 1483. I subtract the two, I get the 677, but it would have a credit balance. So in order to close that credit balance, I would have to debit it. So I'm going to debit income summary for the 677, which I see right there. And I'm going to increase capital with a credit to 677 right there. And the final transaction is to close your drawing account. Your drawing account is part of owner's equity. That owner can pull money out of the account, out of the business at any point during the year. So I'm going to close this 1700 into capital because he is decreasing what the business is now worth because he took money out of it. So I would, let me triple click this. Going to debit that for 1700, and I'm gonna credit the drawing for 1700. So now when you would post all of these items into the ledger, that debit of 1700 and this credit of 1700 would make that account balance 0. So I'm going to go ahead and save that. And then I'm ready for the next step.